Vaibhav Sanghavi, CEO at ASK Hedge Solutions, joining in to talk to us about what's in store for 2025 as a year from here on. Vaibhav, good morning and welcome to the show. My first question coming to you is clearly with the way the reactions that we are seeing in terms of Q3 numbers, stocks with negative earnings, even with the slightest of the negative aspect, are being beaten down right now by the markets. Taking the way valuations are, do you think expectations with regards to earnings growth needs to be trimmed down from here on?
Of course, and to be very honest, I think that would always be the case when you have extremely high valuations and any scope of disappointment, in fact, any disappointment, even though it may be absolutely marginal, I think it will take start to take a knock, when the risk sentiment in the broader market is not very conducive. So in this case, what we are seeing in terms of several names where there is slightest of disappointment, we are seeing more than proportionate reaction to try and see that from a longer term average multiples, it kind of moves towards that. At this point in time, it is kind of trading much higher, especially in the mid and small cap segment.
All right, Vaibhav, if I could just ask you about things global from a global standpoint. And I reckon that this is to a certain extent pertinent for Indian markets. We've had a lot of noise with the US, the elections, the president, and all the sort of comments they're making. We have a different sort of an understanding, a very conflicting understanding of how interest rates could potentially pan out for the US. That brings me to the question that at the moment, we have seen FIIs sell into Indian markets. Are we expecting any likelihood of them coming back anytime soon? And the reason why I ask you is because we want a better understanding of the valuations picture of whether or not we could perhaps see valuations go back to elevated levels. Of course, I know that you have already suggested that valuations are still expensive. Do you think there could be some sort of possibility keeping global events in mind?
No, of course. See, when we talk about 2025, when I'd written an article in terms of outlook for 2025, I'd clearly mentioned that 2025 is a year of government policies and reforms. And to be very honest, it's pretty anti-intuitive purely because after 9 or 10 years of the current government, why am I talking about policy reforms and policies again? Now, in this perspective, I'm not only talking about India, I think I'm also talking about what's going to happen from a US government perspective. What we do expect is basically three or four things. Quickly, one is weaker oil prices. Two, I think in terms of corporate tax cut, which I think to some extent it's being talked about yesterday. Three, I think vocal exchange of views between the between the US government and the Fed in terms of interest rates. Lastly, tariffs is always the case. So in all, what we do think is that it's going to be US industry first, and precisely the reason why we've seen the last couple of months where dollar is kind of strengthening. And because of which also we've seen large part of kind of capital is kind of moving back to US in terms of the record inflows to US as a market. My sense is basically this will continue to happen at least for some time till the time we don't resume our earnings growth or probably stabilize our earnings growth. And from a valuation standpoint, I think we start looking attractive from a relative perspective as well. So let's wait for it. February 1 is going to be an extremely important day in terms of our policy direction and reforms. We'll wait for those kind of events to pan out and then take a call for the next 18 to 24 months.
So Vaibhav, what are you advising your investors at the moment? Keep cash on the sidelines, or are you seeing any pockets where you could deploy?
See, we are a long short fund, right? And we have that flexibility of going into cash, waiting out, and taking out these kind of risk events completely from the portfolio management perspective. So we do these ahead of any big binary events like a budget or probably a credit policy or any event which has the potential to take the market either ways. We generally go in with high cash and probably high hedges as well. So We will wait for the events to pan out, see what is the outcome, and then analyze and redeploy. And that's the liberty we have, from an absolute return fund.
Okay, and going forward, I'm assuming that the approach will be a lot more bottom-up than it was. The question then is, in terms of your expectations for growth in FY26, have you tempered those expectations down as compared to perhaps 3 months or 6 months ago?
Of course, I think that the consensus is way higher, to be very honest, from an earnings growth perspective. While this year is likely to be a big disappointment from a total earnings growth, I think 26 and 27, I think the numbers are likely to get downgraded, as we kind of, go by. So we do expect that to happen. But what is going to be also important is that, when February 1 comes, the direction of the government in terms of capex versus consumption, or probably a combination of both. In fact, that will kind of determine what is the constitution of the market in terms of the movement for the next 18 to 24 months as well. We've seen in the last 9 years to 10 years, the government was laser focused on terms of capex, and because of which we've seen fantastic kind of performance where earnings also growth happened and also multiples kind of moved up or inched up in this whole segment, while consumption kind of lagging. So my sense is basically if we are coming from 2 quarters of suboptimal growth from a GDP perspective, it will be very important to see how the government kind of helps to pump up the kind of economy from here on in terms of the growth rates.
Vaibhav, I mean, two events that we're watching out for, how the impact pans out is with Donald Trump that Agam was just talking about. You have the budget, which you mentioned as well. But apart from these two, what else should be on an investor's radar from an impact perspective? Because clearly a couple of commentary that came in from President Trump was interesting, where he's clearly indicating that companies worldwide should come and manufacture their products in the United States or face tariffs. That's a big statement to make, because if you're looking at a manufacturing hub post-China, we were looking at India as China +1. Do you think this is something which could probably impact your export-oriented sectors also?
See, I think if we see the last tenure of President Trump, I think what we've seen is this, constant talk about tariffs to the extent that it kind of helps them on the negotiating table and kind of arrive at a better trade deal. I do not expect anything away from that. We will continue to see a lot of talk about tariffs, but eventually, I think it will, turn out to, have a trade deal which probably is in slightly favor of US going forward. So that's a pound of flesh they will try to kind of catch up. So America first is of course something which they will play on, but that wouldn't mean that the total trade environment from a global perspective is likely to be disrupted completely. What I do also believe is that while China is going to be an important factor going forward, also the interest rates, how they are panning out, and the Fed policy kind of actions, which will also determine how the global currencies and the flow of capital will also kind of move on from there.
All right. Okay, Vaibhav, we'll leave it at that. Thank you so much for joining us here and talking to us here at NDTV Profit. Wish you the best.